All right, folks, for weeks, right, the hawks on the Fed, every day you looked up, someone was speaking somewhere and pressing a case. No rate cuts, no rate cuts, too much inflation. But the tables have turned, right? Since Friday, Williams spoke out, and now we're hearing the doves, and they're pressing their case, right? And, of course, what they're talking about is the risk to the labor market. My next guest thinks that a rate cut is appropriate for next month. I want to bring in now Landsberg, Bennett, and Private Wealth Management CIO Michael Landsberg. And let's talk about this for a moment, because now the pendulum has swung all the way back at 70-80%, depending on what guide you use for the next cut. But there's still some question marks about next year, early next year. What do you see here?
It shows, I think you're spot on. A couple weeks ago, it was a 30% chance you're getting cuts. Now we're at 80. I think you're going to get a couple in the first quarter. I don't know really what the data is going to show us longer term than that. We had this 2-month data where there was no real data information. I think unemployment is definitely weak. Labor's weakening. But inflation's still kind of hanging around here. It's certainly not going to go back to the Fed's target. So I think you could see a cut or two in the first quarter.
Could there be a de facto target? For instance, let's just say going into next year, Powell becomes something of a lame duck. We know that there's going to be a very dovish person put in there. Maybe they'll have a de facto higher target than 2%, 2.5%, 3%.
They could. It probably makes more sense because I don't know if we're getting back to 2 anytime soon. But yeah, 2.5 is probably more a realistic target. And I think you could certainly see that with obviously we saw Besson talk about maybe having a Fed chair named in December. Yeah. So we certainly could see a lame duck scenario.
Let's talk about today's session. I love today's session, one of my favorite sessions of the year, in part because you've got these huge names down on some serious pressure that normally would have taken the entire market. Yeah, growth is the only thing down. But look at this. You've got all of these, the large, mid, small, all of these different factors, small, killing it across the board. Does this encourage you as an investor, because everyone's complained about the concentration risk? Well, no concentration risk today.
Well, and it's about time, right?
Yeah.
We've talked about it for a long time. Too many investors have too much money in too few sectors, and particularly too few names. So this broadening out is healthy. I think you need to also have some money that's in some boring sectors that aren't as exciting as some of the AI stuff. And in AI, you got to spread yourself out a little bit. Don't just have chips.
Yeah, we're going to bring up your list on that, too, because you make that point. But I want to hit one other part, the volatility. Everyone's sort of saying, listen, it's been a smooth ride. Expect volatility. Sometimes that's the freight we pay, though, right? I mean, to get where we have to go. I made this point last week. We went to almost 29 on the VIX. Typically, when that happens, 6 months later, a year later, the market's actually higher. So what do you tell investors who say, well, the ride is getting a little bumpy?
It is getting bumpier, and part of that's the fact that I think people have less and less money in different names, and the S&P itself now has 35-40% tech, ag communication services, maybe it's 45%, and higher beta names. That's going to happen unless you actively go out and seek some lower beta stuff and to kind of smooth out the portfolio.
All right, let's get to your AI situation here, right? You do say parts of the AI story, though, are a bubble. Parts of the AI conversation. What are you worried about within that umbrella?
Some of the stocks that don't make any money, some of the non-profitable stocks concern me.
Right.
I'm more of a picks and shovels guy here. I like some infrastructure stuff. HVAC is important, electricity. We're going to need more electricity to get from utilities to actually on the cabling to the development places, to the data centers. But I also think we're looking at places that have to keep these places cool. Infrastructure is going to be a big deal. I think, again, just having chips is a problem. Spreading it out a little bit, you're getting some better multiples in some of those places as well.
Right.
Given the fact that AI has run so much.
Let's talk about some specific stock picks. NextEra, of course, that falls into this category. Utility. It's sort of a win-win these days, right? It's a safe haven, but they're going to do well with the data center build-out.
They're going to do well. The other thing I like about the story, it's a demographic story. People are leaving the Northeast, specifically New York. Florida's getting a lot of new business, and that's a demographic story. People are moving.
Yeah, people should know this used to be called Florida Power and Light. Real quick, Ensign Group, because this is a name that's not mentioned on this show often.
Again, a demographic story. It's the aging of America is a theme that we have. It has skilled nursing, outpatient services, nursing homes. We're getting older. People are getting older. They're living longer. You're going to have something to be able to put these folks in and keep them because we're living longer. That's a positive. This is stock that has 8-year revenue growth over 13% a year, and it's a beta of less than 1.
Great stuff, Michael. Appreciate you, man. Thank you very much. All right, folks.